You delivering real alpha? More and more allocators are drilling down into exactly this question in their conversations with investment managers. Specifically, what they're doing is performing a cost-benefit analysis to evaluate whether or not that investment manager is delivering idiosyncratic returns that cannot be obtained elsewhere at lower costs, such as in an index fund or an ETF. Historically, the market has been a stock picker's market, where it was enough for a manager to point to excess returns above a given index or benchmark as evidence of superior stock selection ability. But there have been a couple of changes. The first change that's happened is that allocators are increasingly asking fund managers to articulate their specific, repeatable process for identifying pockets of idiosyncratic alpha. The second change that's happened is that allocators are asking investment managers to exhibit awareness of the ways in which their portfolio might be incurring unintended risks. This becomes particularly relevant when there's a market regime change and a large drawdown, such as what can happen when there's a tariff announcement, a DeepSeek moment, or something else. Let's say you picked a stock that returned 50% during a period when the market returned 25%. Well, if that stock has a beta of 2, you don't really have any idiosyncratic alpha. Moreover, even supposing you pick a stock that outperforms what you would expect based on the beta, if that stock's entire industry enjoyed tailwinds over the same period, you might have a lot less idiosyncratic alpha than you think. These are the kinds of questions that allocators are drilling down into when they speak with investment managers. It's the kind of questions that they look into when they do return attribution or return disaggregation analysis. So there's really never been a better time to learn about factors. In fact, whether you're a junior risk taker or a senior risk taker at a multi-manager firm that uses a factor risk model, or you're at a single manager fund and you're looking to maximize your idiosyncratic risk while minimizing unintended factor bets, or suppose you're at a long only and you're trying to understand the constraints, incentives, and behaviors of other market participants, there really is no better time to learn about factors than today. There's been another change that's happened in the world of factors as well. Fundamental Edge Factor Academy has moved to rolling enrollment, which means that upon enrolling, you can immediately enjoy access to content from some of the world's leading voices on factor investing without having to wait for the next cohort. Link in the description below.